Welcome back, everyone. Today we have some interesting questions from Section 12, Residential Mortgages. Well, I hope you know how this works, but even if you don't, let me tell you guys real quick on how we can move forward with the video. So I am going to ask you a question and give you options. Out of that options you have to choose your answer, and I will give you decent amount of time to choose your answer. If you need more time to think about the answers, don't worry, you can always pause the video. Okay, so without any further delay, let's jump right into the question. Alright, question number 1. A borrower of a $50,000 interest-only loan makes annual interest payments of $3,750. What interest rate is the borrower paying? And here are your options. A. 7.5%. B. 0.75%. C. 3.75%. D. 8.5%. Alright, now I am going to give you some time to think about the options, and then we will reveal the answer together. Okay, I hope you have your answers ready. So the correct answer for this question is option A, 7.5%. The equation for the interest rate is annual payment divided by loan amount equals interest rate. Thus, $3,750 divided by $50,000 equals 7.5%. Alright, question number 2. A lender is charging 2 points on a $60,000 loan. The borrower must therefore pay the lender an advance amount of A. $120. B. $300. C. $1,200. D. $3,000. Go ahead and make your selection now. I hope you have made your selection. So the correct answer for this question is C. $1,200. A point is 1 percentage point of a loan amount. Thus, 2 points on a $60,000 loan equal 0.02 multiplied by $60,000, or $1,200. Alright, next one. A lender who charges a rate of interest in excess of legal limits is guilty of A. Redlining. B. Usury. C. Profit-taking. D. Nothing. There are no legal limits to interest rates. Go ahead and make your selection. I hope you have chosen your answer. Now, let's reveal the correct answer together. So the correct answer is B. Usury. Many states have laws against usury, which is the charging of excessive interest rates on loans. Such states have a maximum rate that is either a flat rate or a variable rate tied to an index such as the prime lending rate. Question number 4. For a loan that is not backed by the Federal Housing Administration or Veterans Administration, and for which the borrower is making a down payment of less than 20%, the lender is likely to require the borrower to obtain A. A subrogation agreement. B. Private mortgage insurance. C. A letter of credit. D. A co-signer on the note. Alright, go ahead and choose your answer. Okay, let's reveal the correct answer together now. So the correct answer is B. Private mortgage insurance. Let's look at the explanation now. Mortgage insurance protects the lender against loss of a portion of the loan, typically 20 to 25%, in case of borrower default. Private mortgage insurance generally applies to loans that are not backed by the Federal Housing Administration, FHA, or Veterans Administration, VA, and that have a down payment of less than 20% of the property value. The FHA has its own insurance requirement for loans with a down payment of less than 20%. Question number 5. A lender lends money to a homeowner and takes legal title to the property as collateral during the payoff period. They are in A. Title theory state. B. Lien theory state. C. State allowing land trusts. D. State where hypothecation is illegal. Alright, make your selection now. Okay, so the correct answer for this question is A. Title theory state. Okay, let's explore what title theory states is. Well, states that regard the mortgage document as a conveyance of ownership from the mortgager to the mortgagee are called title theory states. However, Florida is a lien theory state. Okay, question number 6. A distinctive feature of a promissory note is that A. It is not assignable. B. It must be accompanied by a mortgage. C. It is a negotiable instrument. D. It may not be prepaid. Alright, make your selection now. Okay, so the correct answer for this question is going to be C. It is a negotiable instrument. A promissory note is a negotiable instrument, which means the payee may assign it to a third party. The assignee would then have the right to receive the borrower's periodic payments. Question number 7. What is a loan-to-value ratio? A. The percentage of a lender's portfolio that is composed of mortgage loans. B. The ratio of borrowed principal plus total interest to the appraised value of the collateral property. C. The ratio of a lender's return on a mortgage loan to the value of the collateral property. D. The fraction of the appraised value of the property offered as collateral which the lender is willing to lend. Go ahead and make your selection now. I hope you have made your selection. So the correct answer is D. The fraction of the appraised value of the property offered as collateral which the lender is willing to lend. Firstly, let's understand what loan-to-value ration is. Well, the relationship of the loan amount to the property value, expressed as a percentage, is called the loan-to-value ratio, or LTV. If the lender's loan-to-value ratio is 80%, the lender will lend only $80,000 on a home appraised at $100,000. The difference between what the lender will lend and what the borrower must pay for the property is the amount the borrower must provide in cash as a down payment. Question number 8. Maria borrows $100,000 and pays 2 points for the loan. How much does she pay in points? A. $200. B. $2,000. C. $1,200. D. It depends on the interest rate. Go ahead and make your selection now. I hope you have your answers ready. So the correct answer for this question is going to be B. $2,000. A discount point is 1% of the loan amount. Thus, 1 point on a $100,000 loan equals $100,000 multiplied by 2%, or $100,000 multiplied by 0.02, or $2,000. Question number 9. If a borrower's monthly interest payment on an interest-only loan at an annual interest rate of 6% is $500, how much was the loan amount? A. $72,000. B. $100,000. C. $120,000. D. $50,000. Go ahead and make your selection. I hope you have your answer ready. So the correct answer for this question is going to be option B, $100,000. The equation for the loan amount is annual interest divided by the interest rate equals loan amount. Thus, $500 multiplied by 12 divided by 0.06 equals $100,000. Alright, question number 10. When the terms of the mortgage loan are satisfied, the mortgagee A. may retain any overage in the escrow account. B. may inspect the property before returning legal title. C. may be entitled to charge the borrower a small fee to close the loan. D. May be required to execute a release of mortgage document. Go ahead and make your selection now. Alright, I hope you have made your selection. So the correct answer is D. May be required to execute a release of mortgage document. Lenders may be required to release the mortgage or trust document to the borrower when the borrower has paid off the loan and all other sums secured by the document. The release clause, also known as a defeasance clause, may specify that the mortgagee will execute a satisfaction of mortgage, also known as release of mortgage and mortgage discharge, to the mortgager. So guys, that was all for today's video. I hope you found this video helpful. We have plenty of relevant questions like such in our website dolphinschoolofrealestate.com. So don't forget to visit our website. Thanks for joining in today. Also please don't forget to like, share, and subscribe to our YouTube channel, and we will see you in the next one.